Hi guys, welcome back. So S&P 500 is running up so strongly, but I guess a lot of the retail investors' portfolio is not enjoying as much of the run as it seems. If you want to know why, you can just look at ARK ETF. I think this would represent more of most retail investors' portfolio. Because even right now, most of the retail investors, we're still holding a lot of growth stocks. Right now, the S&P is still up and running, and the growth stocks still under constant pressure, except some special cases, like the specific sectors, or the ones with a short-term to medium-term catalyst. And I think it might still have something to do with the tax loss harvesting in December. So a lot of people would sell their stocks that are at loss to harvest the loss and offset the capital gain, including myself. And if so, you cannot buy it back within 30 days. So maybe this situation might be better in the second half of January, when the investors start to buy back what they sold in December. Right now, a lot of the stocks are moving without the fundamental. They are quite detached already. So I think there's no point to dig into the fundamental to see why it's falling or rising. But I think it has much more correlation with the index, the macro environment, and the sectors they're in. So for value stocks, you look at the S&P 500, right? And for tech stocks, you refer to the Nasdaq index. And medium to smaller caps, it's Russell 2000. And then the traditional sector, like the recovery, the banking, etc., you look at the Dow Jones. So within these index, it seems like even though the S&P 500 has been running so strong, there are other indexes lagging, such as the Russell 2000 and the Dow Jones. So I do think these two sectors would have more of the chances. So these two indexes would have the need to catch up. For Dow Jones, it's quite easy because it only contains 30 stocks inside. So if not Apple, then it might be Boeing, it might be Disney, right? And for tech, Salesforce, the ones that have not grown so much yet in this year, might be their turn next year. Right now, the market is still crashing a lot of the micro caps, which is the penny stocks, such as LKCO. You can see it is getting double hammered by the crash of penny stocks and the crash of Chinese stocks. On top of that, I think people might be worried about the second listing in mainland China or Hong Kong, whether it can meet the requirement. For now, the market cap is too small for that because it has dropped so much. So there is a risk of this, the second listing in Hong Kong, and also because it's below $1 to remain listed in Nasdaq. So they might get a notice. So watch out for the possibility that they might merge the shares. And if that's true, then the share price would continue taking the pressure and have potential of more falling. Just like YQ back then, 1 or 2 months ago, it was a share merge because it was below $1. And this news literally drove it to drive down much more sell-off. And this news literally drove it down much more because of the merging. Because it shows the company did not have confidence the share price can grow back right away, right? So that is why right now the share price movement is pretty much detached from the company, but much more related to the sector they're in and the macro environment. That's why in my last video, I suggested to locate part of the portfolio in the ETF, because even though the HSI might be at the bottom, right? But we never know which sector would grow first, which sector might make lower lows. So maybe at this point, it's not a bad idea to consider the ETF, because once the indexes are more stabilized and the sell-off of growth stocks and Chinese stocks can be finished, the ETF would most likely follow the movement of the macro environment. So you don't need to have headaches on the sectors right now, or scratch your head off when you see that the growth stocks rebound with the market but not your stocks. This would be what I'm looking at myself as well. because I still like some of the big techs like Baba, JD, Meituan, etc. But I cannot predict what regulation the Chinese government might drop on any of them from time to time. So in order to lower the possibility or the risk of a specific stock, I will be looking into KWEB or CWEB if I want my exposure in the big techs. On top of that, the EV sector and the new energy such as solar or hydrogen would be the long-term sector I would hold. I believe even though there are up and downs right now, they would still be the winner sector for the next 5 to 10 years. And other than the Chinese EVs that I am currently holding, I'll be also looking into adding some of the US ones if they give me the chance. Like for example, RIVN or Lucid if the market can have more pullback from here. For the growth stocks, for RIVN, first target 100, second target 80. And for Lucid, first target 35. And second target 30 if it gives me the chance. As you know, I'm increasing my AV exposure more and more. A lot of economists worry about the growth of the economy or even a possible recession. But I think the EV and the new energy sectors would continue to outperform whether if it's a bull market or bear market. So if it's a bull market, it might grow more. If it's a bear market, it might drop less. Of course, stretch it to a long period of time, not like 1 or 2 weeks. So the KWEB consists mostly the internet or tech stocks and would follow also the general growth stocks movement. So if the market continue being like recently, where the indexes are growing but not the growth stocks, then KWEB would follow as well. I do think in the long run, it is a relative bottom, but I cannot predict the next few weeks. If the growth stocks continue selling off, we do need to watch out for the possibility that it might reach lower supports to be around 34. Now that's it for today, and if you have enjoyed this video, please give me a big like and write me a great comment, and I'll see you in my next video. That's it guys, hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.